Um, as, as you know, the webinar today focuses on the basics of financial modeling and why getting them right is so valuable for early and mid-stage companies. It will be led by Gagan Bakshi from Intellecap. Intellecap is a business advisory and consultancy firm which provides consulting, investment banking, and a networking platform to businesses across Asia and Africa within critical sectors, including sustainable development. So the webinar will comprise of 3 main sections which break down the topic for you. Firstly, an introduction to the types of financial modeling and their uses. And it will take you through the building blocks of creating your own financial modeling. Then we'll run through the key elements of a case study company. Please feel free to drop your questions into the chat as the presentation proceeds, and Gagan will address them at a suitable point. Before we start, I'd like to run through a few housekeeping notes. We'd ask you to make sure your microphone remains off during the main presentation to avoid echo and background sound. If bandwidth allows, you're welcome to keep your camera on, but we may need to ask participants to turn the camera off if the quality of the connection deteriorates. And just to flag, the session is being recorded and will be shared within the Energy Catalyst projects who have not been able to attend today. So thank you for joining us today. We look forward to a lively discussion, and I'll update you at the end about future Energy Catalyst workshops. But for now, I'll hand over to Gagan to lead our session. Thank you.
Thank you, Ben. And a very warm welcome. Good morning, good afternoon to everybody. I'm Gagan Bakshi. I head the investment banking practice here at Intellecap. A brief about me, I've been a banker for 21 years and been with the Avishkar Intellecap group for a little more than 10 years. And I lead our private equity and M&A advisory practice in India, Africa, and South Asia. We've been in the impact space for last 2 decades, where we help businesses, early to mid-stage businesses, raise capital from global impact investors in sectors like financial services, healthcare, food, agri, and climate. So these are 4 sectors that really accounts for majority of our work in both investment banking and consulting across the 3 geographies. And as I mentioned, I've been now with the group for a little more than 10 years and been helping companies in India, Africa, and we started to look at South Asia to help raise long-term capital. So that's a brief about me. I think we can get started with the financial modeling session. So what I'm going to be covering today for everybody is that how do we really think about making a financial model, right? Where some of you would have already made financial models, but basically the financial model format and the design and how should you make it, how complex it should be, it all depends on who's your audience and what are they looking for, right? So I'll start with a brief presentation, a few slides, and then what I would like is after the session, the slides, we will run through a case study. It's not going to be easy to cover the entire case study, but I'll share that case study with everybody post the session. But what I would like is try and make it a little more interactive during the case study. So I'm going to request people to, tell me what they think about those assumptions, how you're going to be plotting those assumptions. So try and make it more interactive rather than a one-way communication. Also, right after the few slides, we could do a 5-minute Q&A just to understand if there are any questions in the first section before we head into the case study, right? If everybody's okay, I can get started. Yeah. Is my screen visible?
Yes, it is.
Great.
Yes,
okay.
yes, it is.
So what are we trying to cover in the presentation? One is what is the financial model, right? And the other one is what are the key building blocks for a financial model? So as I said, right, the basic or the financial model depends on who your audience is, right? Because it is supposed to give a very concise information of how your business has been doing historically and how it's supposed to perform in the future. But there's a lot of uh, historical assumptions that go into your financial model that gets vetted by your performance historically, and it has to withstand all the projections that you're trying to make for the next 5 or 10 years. And every business model is very different. And specifically because we have most of the companies are from the energy sector. uh, Energy sector itself has different business models, from, let's say, from hardcore infrastructure to services model, and that's where the models are also different, and we can try and understand and understand those nuances also today during the presentation. So what is a financial model? It's basically a representation of your financial statements. It provides a view of how you've been performing in the past, and how you plan to perform, or how you plan to grow in the coming years. Now, the financial model, and why I said the use of financial model is dependent on who your audience is. So are you making this financial model for your internal budgeting? Are you making this model for, let's say, your existing investors or your lenders? Your model will change. If you are trying to create a financial model for, let's say, you want to apply for a project which is a tender based project, then you create a financial model which is like a bidding model. Then the outcome will always be different. If you are acquiring a company or selling a company, your financial model will be different. If you're doing a leverage buyout, the financial model will be different. And why they will be different, I'll give you a very simple example. Let's say if I am providing this financial model for my lender, from whom I, let's say, have an existing facility, but I am planning to take on a new facility or a new debt. What is the lender most interested in? The lender is most interested in two things. One, can you service? Do you have the ability to service my debt on a regular, frequent basis? And two, would you have enough cash flows to pay my principal? Yeah. And that's what the financial model should show, right? However, if I was raising private equity from investors, then my financial model is not about can I service the debt, it's about can I grow my business? Can I really scale my business faster? Are my assumptions intact? How soon can I break even and become profitable? Can I really start generating enough cash to generate significant shareholder value? So the end result or the end audience will determine how your financial model should look like. And that's why it's very critical before you start getting into a financial model, you understand who your end customer is, or for whom are you making this. Similarly, when you're creating a model for your internal discussions or for your senior management, what are they looking for? They're looking for, how are we doing on an as is versus basis? How are we doing versus our previous years? How do we intend to close the year, right? So they're trying to get a little more granular data about your operations and financial metrics. When you're doing it for a lender, the lender is not looking at too much of granular data. They're looking for hardcore analysis of your revenues and expenses and cash flows to understand whether you have the serviceability intact, whether you can repay my loans or not. So that's how the financial model becomes different. So what are the prerequisites for a financial model? Very importantly, when we start looking at a financial model, there are a few things that we need to keep in mind. One is, what is the macroeconomic situation? What are the, and that depends on the sector that you are in, right? How is that sector changing, right? Let's say if I'm in a rooftop solar business, right? And the overall rooftop solar business, while we all know that the macro situation is that there is significant demand supply gap. And I know that the opportunity is very large. But what is it that will impact my future is not that, but it's more about how many people or how many players are there in the market, how unorganized it is, how is the pricing of the rooftop solar going to behave over the next conceivable future, right? So we all know that the rooftop solar prices have decreased over the last, let's say, a decade. But are they expected to decrease further? Do we expect them to, create a kind of a situation where we will end up locking ourselves into long-term contracts with a particular price, and while my purchase or my supply of rooftop solar is not locked in? So all these situations create a macro view is what anybody would want to look at, whether it's your lender or an equity investor. They will want to look at whether you have your macro assumptions intact and you're able to understand how it is playing out for you as a player. Second is the micro analysis. Now, what the micro is basically about the company. How are you performing in the market? What is your price point? Are you able to offer products and services that compete with the market? Is it better? Are you able to sign up your contracts which are long term versus short term? So those things again impact your financial model. The other thing is, when you're making a financial model, we need to understand the basic financial modeling skills and financial understanding, as well as the Excel modeling skills. We all do not need to be experts in creating the most complex macros in Excel. What we need to understand is how do we make certain jobs in Excel easier versus trying to run macros every time, because doing a VLOOKUP and a macro sounds very exciting, but it also gets very complex, could lead to many errors. So start with getting your basic model correct. If the overall model is simple to understand with your assumptions and linkages, it then makes it easier for anybody to understand and comprehend what you've done. Make sure that every number in the financial model is linked to an outcome, so that people can trace it back and understand where this number is coming from, right? Lastly, I think the financial understanding or concepts, right? So should goodwill, how should goodwill be accounted for? I'm just taking an example, right? Or how are intangibles accounted for? And every country has its accounting policies slightly different than the other countries, but certain concepts are usually common across geographies, but certain concepts are different, right? Can I capitalize my R&D expenditure? Can I capitalize my expenditure that I'm doing on, let's say, setting up or building a new technology for a product? If I can, then what will be the impact of that capitalization versus taking it to the P&L? Now, these are things that one needs to understand before starting the financial model. A very simple thing like depreciation. What does my country allow for? Can I do a straight line method versus a written down value method, right? Or something like intangibles, as I said, right? How is it treated? Then some countries and some sectors have a tax benefit, right? So let's say if you're in a very sunrise sector, the governments usually allow you to take give a tax break for, let's say, next 5 years or 10 years. So if you know your basic accounting policies that are going to impact you or your sector or your company, it makes the model or making the model easier. So I think these are things that one should know before they start making the model. So again, I think most of this probably we've covered, but what you're doing before starting the model, you want to make sure that what is the objective of the model? Who are you making for? Because who are you making for? What are they looking for? And that should become your output. Are they looking for concise cash flow statements? Are they looking for P&Ls and balance sheet? Are they looking for working capital assessment? Or are they looking for just detailed MIS? So all those things actually are very important. And I said, right, audience is very critical, because that's what drives your outcome of the financial model. Right now, during a financial model, what we usually, I think, a format that everybody accepts, whether it is your lenders or equity investors, is one is that your model should always have your historical numbers matching your audited financials. So if you've got your audited financials for last, let's say 2 or 3 years, you make sure that you put that in the financial model as your data as on today. It's a given factual data that cannot be linked. Those are not linked numbers. Those are your historical factual data. Basis that, you create assumptions that help you create your future numbers. And so your financial model will always have your historical numbers. It will always have assumptions which will help you build your future projections. Right? If it's a very new business, you're doing it for the first time, there is no historical, then you just start with assumptions and then start building your financial model with future projections or forward-looking projections. Right? Try and maintain a format and a design that looks neat, that is easy to understand. Sometimes, people try and put in, or, anybody who's making an Excel model tries and put in too much of data, which sometimes is very difficult to understand. I would suggest, and we'll go through one of the models, but what I've realized in the last 2 decades is that the more simpler the model, the better it is. It doesn't need to be very complex unless, your business requires it to be. But, let's say, sometimes I have seen, we have models to arrive at a pricing for a particular product. That can be very detailed and complicated. But if you're sharing a model for your lender, he's not interested in your pricing model. He's interested in what your impact is going to be on the debt and equity when you're raising money, and on your cash flows. So we need to really make sure that we differentiate who's our audience and how complex it should be. Try and keep it as much simple as possible for an external person, let's say a lender or an equity investor, so that they can comprehend the financial model. Try and put your assumptions in one particular color font so that it's visible. We've seen that there's most of the practitioners use a blue color or a green color for assumptions, and then make a black color as an outcome or a linked number. So anything that's an assumption, put it in one color font so that people understand that these are all assumptions. And anything that is linked and is an outcome, put it in one color. So, these are certain things that we keep in mind when we're creating a financial model. One of the points here to keep in mind is error checks. Try and make sure that we have error checks built in so that we know when we are going wrong. This only comes with practice. But let's say, when you make a balance sheet and I have a closing cash balance for the year, if that cash balance is not tallying to the cash balance of my cash flow, then there is a problem, right? If my assets do not match the liabilities, then there is a problem somewhere, right? So these are small error checks that you can do. Let's say another one is, how do you calculate your reserves and surplus, right? Your net worth in your equity, in your balance sheet. Net worth is what? It's simple, is a formula of historical equity that you've put in the business plus profitability of your last year. Now, if I add the two and it doesn't tally with my net worth in the balance sheet, then there is something wrong. So these are small things that will, you could use as error checks, but it only comes with practice. And two is your, financial understanding or concepts need to get better. So this is broadly, I think, really helps in building the a financial model which is simple, less complex, and keeps in mind that who your viewer is. I think I've already mentioned this, a control sheet. The other thing that which many external viewers like is there is an output sheet of certain key ratios. Let's say if it's a where we have an energy business, right? So somebody wants to know what is the impact of let's say how are your electricity charges moving, or how is your consumption moving? Any key critical parameter for the viewer should come in as the output summary sheet. Let's say if you have how many megawatts have been completed this year versus last year, and if it's a derived number, then it should come into your summary. If your revenues, total revenues or total expenses or earnings before tax, these are certain critical summary numbers that somebody is looking for. And instead of going to the detailed P&L and balance sheet, if it's easily visible on a summary sheet or an output sheet, it makes it easier. So that's something that as we make a model, we will be able to understand, but every business will have its own ratios. Whether I should, if it's a lender, then I need to show all ratios that are more important for the financial institution, like my current assets to current liabilities, or my total debt to total EBITDA. All these things is what or my debt servicing coverage ratio, which is DSCR. These are things that the lenders are wanting to understand, and so you would want that to be updated or marked in your summary sheet so that the lender can see what the summary looks like. So these are certain things that I think will come with practice, but based on each business parameter, you should be able to create your own output sheet or a summary sheet. Lastly, I think this is one of the slides. It's again trying to keep it very simple. As I said, the columns are aligned, formats, put your numbers in. You want to make sure that you put your numbers in 1 decimal or 2 decimals. Dates, if you're putting date wise, year wise, then you should use a particular format and make sure the format remains consistent. Font colors, as I said, right, you could use blue for assumptions or inputs and black for a formula, or a green for an external link. So it helps in, and when you're creating your index for the model, it helps in really somebody looking the model and looking at the model the first time, they'll be able to understand how you have made this model. Proper indenting in the model, space out the model, don't try and crunch everything in one row or a one column. So, you can try and use the Excel sheet as well as possible. Make sure all assumptions are in one sheet. I think that's the one basic rule I have always followed, is that when you're making a financial model, all my assumptions, whether it's with respect to revenue, expenses, balance sheet, cash flow, future capital raise, capital expenditure, anything has to come under in one sheet, all assumptions. And try and do that as much as possible. Sometimes it's unavoidable, you have to create a new sheet for certain things, but I think 90% of all your assumptions can be covered in one sheet. Try and put at least a couple of years of historical data so that people can verify that what you're assuming for the future holds good in the past. I think that's one way that usually everybody likes to look at, is if I'm projecting a certain number for the coming year, let's say a price point for a certain product, then people will want to know, have you been able to sell that product at that price point in the last year or a year preceding that? At least 2 to 3 years of experience helps. But in businesses that are very new, it's not about the historical numbers, it's more about the comfort and the confidence on the current product price. So for that, one will have to give other data point that gives comfort to the lenders or the investors on why certain assumptions will hold true. And then you have advanced features, the currency or the denomination flexibility. We usually make it in 2 denominations. One is a local currency, one is usually a global one, either in terms of dollars or pounds or euros, but have one local currency as well, so that you're able to cater to both the both sets of investors or lenders. And sometimes you create group tabs. Group tabs is basically when you have, let's say, if I'm making a model which is monthly, and for 5 years, that means there will be 60 columns. So I may be able to create group tabs to make, to drop it down to, let's say, 5 years. And if I want to expand, I can, just unclick or unclick the tab, and then I'll be able to see all the 12 months. So it's more about reading and visibility, but it helps in grouping your tabs and make it look neat. And then if somebody wants to delve or dig deeper into a monthly number, they can always ungroup the tabs. So these are small things. I think it's again, as once you start making a business model, as you start interacting with your lenders, equity investors, or your internal teams, you will realize what is missing and how your model can get better every next time. So there is nobody gets the model perfect in the very first time, and nothing to fret over it. But I think what's important is that if you've been able to highlight your assumptions very clearly, if you've been able to take care of what your historical looks like versus what your projections are going to look like, if your macros are and micro understanding is clear and you've been able to articulate that in the model, I think it will become easier for anybody. And as you gradually start getting deeper into the financial model over the years, you will be able to fine tune that model as you get better. But one thing that has always worked is please keep it simple. I think that works every time. Yeah. So this is broadly the first section that I think I wanted to cover, and I'll take a pause here. Maybe have people just raise questions if they have any before we get into the financial model.
So, Gagan, we don't have any questions on the chat, so maybe we can just request if there are any questions for people to just unmute themselves and ask.
Sure.
Right. So Saad has raised. So Saad, please unmute yourself and ask your question.
Hi, good morning, everyone. Thank you for the wonderful presentation. Personally, I have more experience working on financial models for new businesses, so I'm not too familiar with how historical evidence comes into play. So, for example, you mentioned things around financial statements. So I don't know if we'll have time to go into examples, but it would be good to see how you're able to bring those sort of data into your financial model to make them, as you said, a lot more grounded in reality and not just on assumptions. Thank you.
Sure. And I think we'll discuss that when we run through the model on how you can integrate that into the financial model, specifically for enterprises that are new, don't have historical experience, or have not done, it doesn't have any historical data, and you're doing it for the first time. So I think one point here, and I think we'll discuss it in the model as well, but when you're making a financial model for the first time for a business that is new, what any viewer is looking for is the basis of the numbers that you are projecting. So if you're able to back up your data on your assumptions, I think that will give enough comfort to any viewer. And I think we can discuss a lot more as we get into the model, but ideally just try and make sure that you have a basis for every assumption that you have for your projections. That is the only way you will be able to give comfort to your viewers, as well as make a good financial model.
Thank you.
Are there any further questions at this point of time, or should we, otherwise we'll move on to the case study? I think, Gagan, maybe we can move on to the case study. I believe there may be more follow-up questions post that, since that will give them an idea about how to picture a financial model.
Sure.
Yeah.
Okay, just let me know if my screen is visible.
Yes, it is, Gagan.
I'll just try and
yes, this looks good. It's pretty clear at our end.
Okay. So this is a simple financial model. We've created a case study here, but basically and I've intentionally not taken an energy company here because I felt there will be many energy enterprises, one different from the other. So tried to keep it neutral and taken something from the food segment, but happy to share experiences and maybe understand your queries around your business and how we can answer that also with respect to the financial model. So this is a company which is a on-demand food delivery company, and it have, as it says, it offers a standardized menu of Indian cuisine. Now what we've and I've started, and this page is basically about giving assumptions. Now how these assumptions come up is by discussions with the person who's wanting to have a financial model made. So if I'm sitting with an entrepreneur, I would try and understand all the nuances of their business, and how they are captured, what all expenses are incurred, and basis that will help make a financial model. So you will be able to see certain of assumptions here. So what is happening here is that they are setting up takeaway centers, right? So on-demand food delivery companies setting up takeaway centers at various locations. Now they are planning to set up these centers every year. So starting with 20 in year 1, and then another 30 in year 2, and so on and so forth, and then year 5, 50, right? And these are each year they are getting added. So overall, they are probably adding 180 odd centers over 5 years. Now that's the plan, right? So this is the first time you are building a model for a company. Company will adopt a mix of a leased and owned center going forward. 1 out of every 5 center added will be owned, right? So this is an assumption. So when I'm talking to the entrepreneur, he wants that he has a mix of both owned and leased outlets, and out of every 5 outlets, 1 of them is going to be an owned one, while 4 out of 5 will be leased. It is also assumed that the new centers are added in April and take 6 months for refurbishments before becoming operational and revenue generating. Now, very important, this is a very important assumption, because depending on your financial year, and I've taken April here because of the accounting standards in India, in April to March as the financial year. But for you, if it's Jan to December, you would want to know when will you start building your asset or the centers, and when and how long do they take before they become operational or commercialized, because that will help you build your revenue for that year going forward. So what we are assuming here is that all these centers are being set up in April. All 20 will come. This is again from a simplicity perspective. All 20 are coming up in April, and they will take 6 months to commercialize, and after that you will be starting to generate revenue, which means in the first year of operation they will only be running for 6 months. Now, because it's a center by center business, you will always need to build a center level economics, which means that if let's say you are setting up solar projects, for an example, across 20 locations, you will want to know how each project is running. Is it making money for you or not? If let's say you have distribution centers, then you will want to know is how is each distribution center working. So what we try and come up with, whenever there is a model which requires us to look at a center level P&L before we come up to a consolidated level or a company level, then the center level economics is very important. So again, we have laid down some assumptions here. The first assumption is that each center generates a revenue of $1.2 million per month and is expected to grow at a 10% year on year from year 3, right? 70% of my sales are on cash basis and the balance are through credit cards. The credit card company clears the payment within 45 days, which means that my part of my sales have a receivables of 45 days. And that is how much? It's only 30% of my sales have a 45-day receivable period. 70% is on cash. Cost of food and consumables, my raw material cost constitutes 30% of my sales. And the payment, I make my payment to the vendors within 30 days, which means my creditors are for 30 days. as per company policy, each center is required to stock food and consumables for 15 days, which means I'll have raw material inventory of 15 days. And each center is staffed with one chef, one helper, and 2 delivery boys, and then we've given their salaries respectively. And then there are other operating expenses like utilities, delivery charges, packaging charges, and commissions. All that as a percentage of sales is also provided here. What else are we looking for at the center level? We also need how much rent or other, if it is a leased one, then what rent or lease are we paying per month? And if there's a security deposit, how much is that? If it's an owned center, then what is the cost of the owned center? How much have I paid for the land or the building? And have I funded that land and building entirely with my own money, or have I taken a loan? And if I've taken a loan, then what are the what's the interest rate and what is the repayment period? In this model, we've assumed that it has an interest cost of 14% per annum, and the principal is repaid within 3 equal and annual installments. Now, this could be 5, 7, it could be quarterly instead of yearly, but we've taken a yearly just to make it simpler to understand. And then you've got a refurbishment cost per center is around another 1.2 million with a capex of $800,000. Right, so these are assumptions, right? When you're talking to the entrepreneur, you try and get as much color to how they run their each unit or each SPV or each branch, and that is what will help you build a model at the branch level versus at the company.
Hello.
Hello.
Me pacho.
Gagan, I think you can continue. I think somebody just unmuted themselves by mistake.
Oh, okay.
Yeah.
Yeah. And then you have, once you've understood what the branch level or a center level assumptions are, then you look at what are the assumptions in the overall business, which means how much have promoters contributed to the equity of the business? What are your marketing expenses in general every year that you plan to spend? I've given an assumption here that we are spending around $10 million, which is increasing by 5% year on year. What are your corporate expenses? Corporate expenses means the salaries of the corporate team and the rents, other electricity and all for the corporate office. So the corporate, we've assumed here a 7.5 million number. What inflation are you using or assuming for your sales and for your expenses? Are you expecting the costs, while the costs go up every year with inflation, is your revenue expected to grow every year or not? What is your depreciation that you have? So if I'm incurring a capex, there is a depreciation for it. So what does my accounting policy say? How much can I depreciate every year for how many years? I've assumed here that the depreciation rate is 8% and is on a straight line method, which means when a straight line method basically says that I will have a equal depreciation amount every year for the next 5, 10, whatever years that depreciation is allowed for. What's your corporate tax rate? When you're building a financial model, you also need to know, do I need to maintain a minimum level of cash or not? And if that I have to maintain that, then how many months should I maintain that for? Also, when I'm funding my cash flows, do I do entirely with equity or do I do a debt? And if it's a debt plus equity, then what should be my debt equity ratio? Can I lever it 2:1 or should I restrict it to 1:1? We are saying that this model or this business should not be levered more than 1:1. However, more capex heavy businesses or infrastructure businesses are usually levered more. We see a leverage of almost 3:1 in heavy capex industries or heavy, let's say, energy businesses, where there is a significant capex involved. Usually lenders have a comfort to even go up to 3:1 as well in terms of debt equity. I think we've put some assumptions at the bottom for valuation, but I think that's something that we can avoid for today's discussion. But what is important is how is your balance sheet, what are your balance sheet assumptions, and what are your revenues and expenses that will help you build your P&L, balance sheet, and cash flow. I think that's very important. If you've understood your balance sheet assumptions from the entrepreneur well, if you know what your macro and micro understanding is for the business and for the industry, then it becomes easier to ask these questions. And as I said, right, every business will have its own nuances, so we need to be a little more, we need to spend a little more time in understanding the market dynamics before we ask these questions. Sometimes, the business is very new, doesn't have much history. So you look at what the others are doing in the business or others are doing in the market. How are they pricing their product? So somewhere we need to have certain bases and for an assumption that will help us build the model. Now, because this is a center or a branch-led model, we will the first basic rule when you're making a model is, before you make a consolidated or a company level P&L and balance sheet, what you need to make is a center level P&L or the expansion and the revenue and expenses for each center before you get into the company level P&L and balance sheet. That's usually the way it is followed. Whenever there is a branch-based model or a center level, you'll first try and understand how the center level economics works, and then use that and multiply that to make a company level P&L and balance sheet. Yeah. So we'll see that here. Just let me. Okay, this should be visible. Yeah. So I've tried to just plot these numbers to help you understand what we are trying to do here. We are trying to say that from, let's say, for the next 5 years, what is going to be our revenue for one center? How is one center going to perform? So if you remember, my the assumption was that whatever is my revenue, I will multiply that for the year one. It is only operational for 6 months. So I have plotted my number of months in operation, 6, 12, so that it's easier to multiply rather than putting in a hard-coded number. As I said in the presentation, try and put every number and link it so that it's easier to understand where the numbers are coming in from. So usually we plot the number of months of operation at the very beginning, so it's easier. And we also put in the denomination, so everything is in $100,000. And so when you read this, it basically means it's like 7.2 million. And so what we are doing here is the revenue for first 6 months is this much, and then for the next year it's the same revenue into 12 months, and then after that you are increasing it by 10% year on year. That's what the assumption said, that from year 3 the revenues will increase by 10% every year. Again, all my assumptions, my food is at 30%, so I will, of my revenue, I will just, if you see the workings here, I have linked my 30% with 72, and the 30% is fixed with a dollar sign, so that it's a fixed number, it doesn't change, and you just pull this over. As you pull this over, this 30% gets multiplied with the numbers here on the top. So just let me just remove this for now. And as you see, this 30% into 72, I can just pull this formula, and this is what my number will look like for the coming next 4 years, right? It just gets multiplied with the same 30% into revenue for each year. Similarly, my staff cost, we've already said how much is the salaries that I'm paying per month, and I divide that and I multiply that into 7 months for the year, because my outlets are going to be only operational for 6 months in the first year. The same thing again, as I kept it fixed, I will multiply that for the next 4 years. Again, other costs, this is the other cost that I had shown here in the assumptions. This is 5.5 plus 12.5 plus 7 plus 3.5. Because these are all as a percentage of sales, I've clubbed it here as and you can break it up as well. I've just clubbed it here as other costs, and again linked it with the revenue. Then you've got your rental cost, you've got refurbishments. There's a one-time refurbishment which is mentioned, and this gives you your total cost. When you subtract this from your revenue, you get your EBITDA, which is your earnings before tax, depreciation, and amortization. And this is a leased model. That is why you have your rental here for the branch or the center coming here. Then you have your depreciation. Now, how this depreciation is getting calculated is also given at the bottom. We were starting with a, if you remember in the it said that we have, just a sec, yeah. So, okay. Now, my capex for the equipment is $800,000. Now that 800,000 is my, in the first year capex that I've spent. My depreciation is 8%. So I will depreciate this $800,000 over the next how many years? It will probably be 8%. You will divide by, this is what will happen. It will be divided by the, so 12.5 years is what you have your depreciation for, because it's 8% every year. So the asset can be depreciated over 12.5 years. How much will you depreciate that is given here. So because the value was 800,000, you will divide that by 12.5 years, and that amount will be fixed for the next 12.5 years. Because it's a 5-year model, we've just projected it for 5 years, right? Now, this, but you've got your opening balance, you've got a new equipment, you've reduced the depreciation, you get your closing balance, which is your net fixed assets. And as you see, your net fixed assets keep decreasing by the amount of depreciation every year. This depreciation gets linked in the P&L. And so people, whoever look at this number, can go back and see where this number is coming from, and then go back and check how this number is getting calculated. Similarly, if you have taken any debt, you will have an interest cost here. Here, interest is 0. So because it's a lease center, I'm not taking any debt to finance my center, and that's why my interest cost is 0. If I reduce my depreciation and my interest from my earnings before tax and depreciation, I get my profit before tax at the center level. Now, mind you, we had a corporate tax rate of 30% or 33%. That corporate tax rate does not apply on the center. It applies on the total profit that you make at the center level, at the corporate level. At the center level, you only calculate up to the profit before tax, right? Now, because I've given a security deposit, this will always show on my balance sheet as a fixed amount of $5 million. It's something that I've paid, or sorry, $500,000. We have paid this, so it'll just show as a security deposit on my balance sheet. Yeah. And now, because if you remember, one of the assumptions was that every 5 leads or every 5 centers that I open, 1 center will be an owned center. So now you're going to make a P&L for your own center as well and see how it is different. Yeah. Again, we start with the same assumptions, right? Your revenues, as you can see, your expenses. Now, what I've done is, for ease, I have linked this same number with the leased center, because my revenues and my expenses are same for leased or for my owned center. So I've just linked it to the previous sheet and do not have to paste my assumptions again. But unless if your assumptions are changing, then you need to build out your assumptions in the same sheet here itself. What I've only built for here is if you can see, my rental cost is 0. Because this is an owned asset, my rent is 0. What I've taken up here is my depreciation and my interest cost. Why the interest is here? Because I have taken up the center at a fixed asset of 30 million or $3 million, $30 million. And because I've funded that with my debt and equity, I have some interest coming up. So Now, there is, if you see this land, usually, let's say in India, land is not depreciated. So whatever the value of the land, book value of the land is, it continues to remain as book value on the balance sheet. So my 30 million remains fixed as 30 million, it doesn't change. Now, we are financing this 30 million with a debt equity. So what does it say that I'm financing 70%? Let's say if I'm financing 70% of my land or my cost of this capex at from debt. So 70% will be my debt, which is 21 million. And on that 21 million, I will be making a repayment in 3 years. That's what the assumption was. So 21 divided by 3 is a 7 million payout every year. So that's your fixed. You cannot change that. Apart from that, what is my interest cost? It's 14%. Now, 14% is going to be paid on the average balance from the opening and the closing. So my closing is 21 minus 7, which is 14. And my average would be, interest would be 14% of my average balance of 21 and 14. What is that average? You can just put a formula there to take your 14% of average of D39 and D42. It gives you the interest cost for the full year. If now the interest is supposed to be taken only for 6 months, then you divide this by or divide by 12 into 6 or divide by 2, and you get for half year as your interest cost, right? So what is, if you now notice the change that is happening here is that my EBITDA margins have shot up to 31% in an owned center versus a lease center, which is currently at 27-28%. And the reason why it's higher there is because you don't have rental cost. You're not paying any rent for the center. You just bought that center, so there is no rent, and that's why you are able to save on the rent cost and your EBITDAs are higher. Right? Now, once you have built your center level economics, you start building your revenues and costs. Before you even get into the P&L, you try and project your revenues because you have multi-year revenues for all the number of centers that you're going to open. Now, just keep in mind that this branch or center level economics is for one center. Now, as you get into the revenue, first you will plot how many centers are you opening. So in year 1, you've opened 20 centers. In year 2, you opened another 30. And this, I have kept them as 30 as a constant there because you will realize why it's constant. Then in year 3, I've added 40 more. In year 4, another 40. And final year, I've added 15, right? It's important to build it like that way because you will now see the impact that it has on the model. Now, what is your revenue per center? Right? Your revenue per center is what you already have built in the center level economics. So you plot your revenue per center here, and then you start creating the overall revenue matrix. This revenue matrix is basically all the 20 centers in year 1 will have a revenue of 72 million. And as you grow, and the same 20 centers will give a revenue of 144, which is what your number here is. The same 20 will give a revenue of 158, and then they will give 192 in the final year. So that is why this 20 center revenue is very important. Similarly, the new 30 centers will start from next year. So this grid starts to form up. This 30 again will start from the beginning. Please keep in mind that because every new branch will follow the same pattern. They will first be operated for 6 months and then for the full year. So the next 30 will again start from 72 and then next year get multiplied by 144 and then by 130. So the final year, as you see in year 5, my 50 centers will only give me 50 into 72. So the total revenue that I will make is a summation of all these. And finally, I will make let's say a 250 million kind of revenue in the 5th year. My staff costs have already been given, right? This is again per center. What I will do is again, I'll create a matrix for year 1 to year 5 in the same format, and I will have my staff costs. Similarly, my lease center because I'm paying a lease, what will be my lease for that center? I have plotted that out here, right? And then the rent cost, right? So this is where I have plotted my total rent as well. Once I have my total expenses and total revenues, especially for the center level, then I can move into the, it becomes easier to plot this in the P&L, right? Now, a very simple format, you've plotted your 5 years with your revenue, you've got this revenue, right? Which you get from your revenue sheet. Now, what you can do is one of the things that, the assumption was that my revenue is 70% cash and 30% is cards. So you break that up to show somebody what the breakup of the revenue is. Then your consumables, everything is getting linked if you see to the revenue sheet. So all these numbers are linked. So, people can actually look at these numbers. There's no hard-coded number. This makes it easier for the viewer to go back to that cell and cross-verify where that number is coming from. My rental costs are here. All other costs are as a percentage of sales, if you remember. So this, you can just take that 28.5% and just plot it as a percentage of sales. My refurbishment cost is very simple. Link it. You've got your marketing expenses already. Through the assumption sheet, you know what the numbers are, and you will plot that with a 5% inflation. Corporate overheads, again, from the assumption, it says it's 75, and then you can increase it by 10% year on year. So this gives you your total cost. This is at the company level. After putting in your marketing and corporate expenses and overheads, you get your total cost, and then you get your corporate EBITDA. Now, after putting in the corporate EBITDA, you get into the depreciation, the interest cost, and then if you end up making profits, you will have a tax. Because our tax rate is 33%, so we've just put a formula here saying that if my profit for the year is above 0, then I should be paying a 33% tax, right? So because this was negative in the first year, so there is no tax. Otherwise, every year I'll pay a 33% corporate tax. If you minus the tax, you get your PAT, which is your profit after tax, and and you can take a PAT margin, which is this number divided by your total revenue, is your PAT margin. So this gives you a broad revenue or a P&L. Now, similarly for your balance sheet, right? The assumption said that the promoters started with an equity contribution of 30 million. So you've plotted that number. And then you talk about, now before you get into the balance sheet, you also need to understand how is your capex and loans getting impacted and how much debt equity is required. So you create another sheet wherein you will plot all the capex as we did for the various centers. You've plotted all your equipment and capex, and after plotting the land and capex and everything, we decided to take a 70% loan, so that loan amount, your repayment, everything gets plotted here. After that, once your repayment and repayment schedule is done, you will know what your total capex is, right? And that total capex becomes your total asset in the balance sheet, right? Total debt or bank loan here will become your total liabilities, and your total interest that you're making a payment here, which is your number here 4, 12, 21. This interest payment will go into your P&L, right? So if you come back to the balance sheet, yeah, now as you start plotting in the numbers for your reserves and surplus, now what is your reserve and surplus? As I mentioned, because it's a first year of your business, your reserves and surplus will be the profit or loss that you make. So if I made a loss, so I link it with the P&L. In the P&L, I had a loss of 55 million. So I will have a reserves and surplus of a negative 55. And then gradually, I will keep adding the profit or the loss every year. So from 55, I'll add the profit for the next year and then keep adding that cumulatively. Keep in mind, the balance sheet is a cumulative as on date number. So the reserves and surplus is a total cumulative profit or loss as on date. plus the equity that you've contributed till date, right? Again, the bank loans are given from your capex and loan sheet. You just link it here, and that's where you get your the overall liabilities from a company's perspective. The other thing is that because we are making our vendor payments every 30 days, so we have creditors. We've calculated creditors as a 30 days. If you can see, it's linked to P&L D10 into 30 by 365. So what we do is let's go back to P&L and D10. D10 is your consumables, your raw material. Who are your vendors? The people from whom you have your raw material sourced. So your creditors will always be calculated on your total COGS or cost of goods sold. Here, my cost of goods sold is 432 million. This is for the year. Because I am making payments every 30 days, so my creditors will be 30 days outstanding at any point in time. So I will calculate this. I'll divide this by 365 and multiply it by 30. And that will give me the total creditors for 30-day period, which will get calculated here. Similarly, next year, I will again calculate that same thing into 30 by 365, and I'll get the creditors for the following years as well. On the asset side, you've got your net block, which is your gross block minus your depreciation. It again comes in from the capex sheet because you've calculated your total capex, your closing item. Here, if you can see my net block, the net block here is 147,374, so it's going up. That's the number that gets plotted. The debtors. Now, the debtors, if you remember that I was keeping my credit with the payments that I get through credit card. My credit card company makes a payment after every 45 days. So same again, because it's on my revenue. So my sales into 45 divided by 365 will give me the receivables or the debtors for that year. And that same thing can get multiplied for future years. Inventory, again, very simple assumption we had made that I keep a raw material inventory of 15 days. So whatever is my COGS or my cost of goods sold or raw material, that into 15 divided by 365 will be my inventory days. Advances. This advance is basically the security deposit that, if you remember, we were supposed to make a payment of. So for every leased center, we were giving a deposit of $500,000. So we will multiply with the number of centers that we are opening every year in leased, and this will be my deposit that will keep getting accumulated. So I will, at the end of 5 years, I'll have a security deposit to be received from my from the landowner or the the person who's lessing, who's a lesser. And an amount equal to, let's say, $720,000 or 7.2 million, right? Now, I have built in a minimum cash and a surplus cash because we wanted to make sure that there is a minimum cash available at any point in time in the business. So we've calculated a minimum cash, and then whatever is a surplus over and above the minimum, it's shown as surplus cash. At the end of the day, you want to make sure that your total assets and total liabilities are zero, right? This is a security check. So just, you can always put a small formula here of total asset and liability just to make sure that they are always zero. And if they are not, then there is something wrong somewhere. The cash balance in the balance sheet should always flow in from your cash flow. If you can see the link here, it is to CF. CF is the cash flow statement. And then as we are making our balance sheet, or once we made the balance sheet except the cash, we also start making the cash flow statement. Cash flows at various businesses represented in a very different format. But this is a simple cash flow. You always have cash flow from operations. You have cash flow from investing activities, which is basically after putting money in your investments or capex or fixed assets. And then cash flow from financing activities, which basically is how much of that investment every year is being financed through debt versus equity versus internal accruals. So that is how the cash flow will be broken every year. So this is my cash flow from operations. In the first year, I have a loss, but because depreciation is a non-cash item, it gets added back. And then you've got your debtors, inventory, advances, and creditors. All that leads to cash flow from operations of a negative 158,000. This gets, and then apart from this, I have fixed assets, the capex that I incurred. So I've incurred in a capex of 280,000. So, which basically means now I need to fund this 280 plus this 158. Where am I going to fund this from? Both bank loan and equity. So my bank loan has been given from the balance sheet. My equity is also what as a promoter I am infusing in. If you remember, the promoters were putting in money of 30 million in the beginning and then growing that. So we made an assumption here, but this assumption can be always modified to see how much cash is required in the business. But at somewhere the equity infusion is also hard coded so that we can back calculate the other assumptions. But the more, sometimes we are to avoid any circular referencing, one or two assumptions are always hard coded so that we don't get a circular reference. But ideally, you can keep the equity amount as fixed and let the other numbers be derived. Once you've got your cash flow statement, it tells you how much is your opening cash. If because it's a new business, opening will be 0, but then you'll have your cash flow for the year, and then closing cash, and how much is a surplus, right? Now, in all this, what we also need to make sure is that, as we had said, that 2 months of operations I should have as my, or 2 months of raw material, or 2 months of expenses, total expenses should be as a cash available in the system. So I have just put a minimum cash here as a separate line item to understand what that minimum cash is. So if I look at P&L D17, my total expenses are, let's say, 14 or $14.78 million. 2 months of that is what my total cash is required, which is 246,000. Now, because I have a closing cash of 268, my surplus is 268 minus 246, which is 22. So my minimum cash is 246, plus I have a surplus of 22. So I'm going very strong on liquidity and cash flow. So that really is a good situation. But it also means that there is a lot of cash lying idle. So somewhere maybe the business is not doing justice to the kind of cash that is already available, right? But this basically also tells us that we've probably not either leveraged our operations well, or we've infused too much of equity, or we've not expanded too fast enough, and so on and so forth. So these are certain questions that will be posed once you make this financial model. But this is where you get your cash outstanding, and then you plot this back into balance sheet to make sure that your assets and liability tally. Because you've got your cash in the balance sheet linked to your cash flow, your assets and liabilities then will ideally should tie up unless there is some mistake somewhere in other calculations, and you will be able to do that cross check at any point in time. I've also calculated the DE, which is the debt equity ratio, just to keep in mind that are we taking on too much equity, or are we not leveraging? Here, as you can see, the assumption was that we could go not more than 1x debt equity, but I'm actually even less than 0.1x, which means that actually I've either infused too much of equity or I have not leveraged enough. So which also means that either I can reduce my equity or I can increase my expansion plans and take on more debt on the same equity level, right? So these are all things that one can discuss, debate, and then fine tune the business model. So I'll stop here and now maybe request everybody to come back with questions. I think it'll be important to now discuss more specifics so that it can become a little more informative and how it can impact your business models. I know it was a little bit boring, but I'm hoping that you will have questions for me to help you understand the nuances of your business and maybe how best you can plot them.
So Gagan, maybe I'll just read out. We have one question from the chat box. So Faisal wants to understand that what is the typical IRR and ROC that impact investors look for?
It's a good question, Faisal. I think there is no common IRR or a return on capital that all investors go by, because an impact investor today is also turning out to be a lot more commercial, right? Because many businesses that have grown, which were supposed to be initially impact oriented, have started to give significant return on capital. And so impact investors also want to make sure that they also should not lose out on that return. But having said that, I think a business that has a healthy 15% return on capital, I have seen investors, all kinds of investors being interested. ROEs will be dependent on how much is your debt equity in the business and how much ROEs you are generating. But return on capital, essentially, I feel at 14-15% is a very sound rate that investors go by in general.
Yes, Craig, please feel free to come in.
Hi, thank you. Thank you for the useful information. I'm interested in, and you've mentioned this a number of times, the debt equity ratio. Is there you talked about where there's a lot of capital, obviously you can get asset financing and that, but are you using fairly standard sort of ratios, say 2 to 1 of debt equity? Is there a standard sort of amount that you would recommend?
So Craig, I think, I have seen it going even up to 4x in certain industries. But having said that, I think locally, in your country, if it's, let's say if it's UK, your existing or your lenders can basically tell you what the comfort that they have in terms of the debt equity. But power assets in general are usually, because they have a long tenor of life, most of the power assets can be run for more than 25-30 years. In many of those kind of situations, I have seen lenders easily going up to 3x debt equity. Does that answer your question, Craig, or was it, or is there anything else that I would like to, you would like me to address?
Well, yeah, it's just that equity tends to be quite a high cost of getting money into the business. So you tend to think, oh yeah, that would then come with a higher risk to the investor, but generally they're quite risk averse. I don't know if it's just at the moment, so I'm wondering, is it, well, are you using standard figures there? If it is 1-to-1 not uncommon, if leaving aside the assets, the capital expenditure, or presumably you're trying to get as little equity as you can and as much debt as you can if you're needing money, right?
So I think that's the most ideal scenario wherein you should have the least equity and the most debt. But what happens is, from a lender's perspective, can your business sustain that kind of debt equity, then becomes a bigger question. So why we in let's say heavy capex industries and specifically power assets, we see debt equity going up to 3x or even higher, is because those assets have regular cash flows, and those cash flows can sustain a debt repayment of over 10 years and above. I remember even power assets in India are financed almost up to 15 years because they have a 25-30 year life and they have a fixed cash flow. It's easier to finance up to 3 or 3.5 times debt equity for over, let's say, 15 years period. But in certain industries, that may not hold true, right? Where you have flexibility, where there is volatility of revenue every year, where costs are not very certain, your revenues are not very certain. There, I think lenders will not be comfortable going up to 3x. Probably there the market norm is anywhere between 1.5 to 2 times debt equity. The other thing, Craig, which is very important, is that it is the, I can probably try and keep as much low equity as possible, but the equity investors also understand that the cost of equity is very high, but certain businesses need to be funded with equity early on because lenders are not comfortable, right? Lenders get comfortable when there are healthy cash flows. So till that time the business has not started generating healthy cash flows, it is the risk of the equity investors that really comes in handy. And that time we end up raising actually a lot more equity, just so that it gives us comfort and allows us to withstand any calamities or uncertainties that may come up in the business.
Got it. Okay. Yeah, thank you. I appreciate this is a slight tangent to the modeling overall that you're talking about, but I was just interested to know how you came up with those figures. So thanks very much.
Sure.
Gagan, we have another question in the chat, so I'll just read that out for you. The question is, for off-balance sheet based investments, that is mainly equity driven, what tends to be the duration for returns to be achieved for most investors? Also, what are the key indicators such investors would be interested in seeing?
So when we say off-balance sheet business, is this with respect to what kind of product or service? Is it a financial services business or?
Saad, may I ask you to unmute yourself to answer that, so that Gagan can potentially give you better insight, or you can feel free to also write in the chat box if that's something that you prefer.
Sure. So it's mainly through project vehicles, infrastructure-based investments. So you're looking at very, very rich assets that are physical in nature.
Okay, so these are investment in vehicles. Okay, so in that case, Saad, what we've seen is that the investors, in existing cash flow business models where there are returns that are possible, the investor duration depends on the kind of investor you reach out to. So you would have also seen that private equity investors seldom look at energy assets, right? However, infrastructure investors look at infrastructure assets or power assets. The reason being that one is the holding period, and two is that they're happier making lower IRRs than pure play private equity investors. And so in a general sense, I have seen investors in these kind of vehicles wanting to have a duration of at least 7 to 8 years to really get good IRRs. And I think that's the flexibility most of these investors look for, rather than looking at a quick exit. I think many of these long-term infrastructure assets require investors with at least a holding period of at least 7 years and higher.
Would you like any more clarity on that, Saad?
No, that's very welcome. But just second part of the question around the key indicators that you want to hero on your financial model to make very prominent as well.
So I think
such infrastructure-based investors.
Yeah, I think on the specifically on the infrastructure opportunity, right? The what the investor is looking for is the certainty of cash and certainty of receivables. So let's say if you're doing government, on behalf of the government, you are running projects, then is the government making payments on time or not, because that's a very critical element of what the investors want to look for, because in some geographies or some countries, the government may not be a great paymaster to that extent, and so that's why that impacts the overall viability of the project. But what is the the certainty of the cash flows, what is the stickiness of the cash flow or the revenues, and what is the tenor, how long will you get your cash flows for, and then what is the return on capital employed. Basic return on capital for many of these infrastructure assets, I have seen anywhere between 12 to 15% is a very good indicator of a healthy project on the return on capital employed, not return on equity. I think return on equity would probably be, let's say, around 17 to 20%, but 12 to 15% return on capital employed is considered to be very healthy. And I'm giving these numbers more from a Indian context, but depending on which geography the projects are, these numbers could be slightly different. Let's say if you're doing it in Africa, there the cost of debt is very high, so your return on capital employed will also get impacted accordingly.
Thank you very much.
We have another 7 minutes left into this session. So just, opening up the floor again in case we have some time to take in 2-3 more questions before Ben comes in to close. Okay, maybe Gagan, I think, yeah, Ben's on now.
Yeah, thank you, everybody. Thank you, Gagan, in particular. I know you've got a hard stop at 12, so let's bring this to a close. Thank you for a brilliant workshop. We're going to put a link in the chat to a feedback form if you'd like to let us know what you thought of the session. I'd also like to give you a heads up about the next webinar taking place in July. This webinar is on debt and equity crowdfunding and its role in the fundraising journey of energy access companies. It will include examples of and tips on successful campaigns and a short list of the most relevant crowdfunding platforms for the Energy Catalyst cohort. It will be hosted by a resident crowdfunding expert who has 10 years of experience working with companies to raise capital via crowdfunding. So keep an eye on your inbox for an imminent invitation to join this session when the exact date is confirmed. I'm also going to drop the link for the Energy Catalyst members only group in the chat, so you can click to join if you haven't already. If you don't know, this is an online space where you can find news about other Energy Catalyst companies, sponsored opportunities like brokerage trips, and links to knowledge management products. And we're also planning to add video content produced by companies themselves as a means to foster peer learning. So it's well worth joining this group now. Thank you all for participating in the session today, and hopefully see you again at the next webinar. Thank you. Goodbye.
Thank you, everyone. Thanks. Bye-bye.
Thanks for a great presentation. See you.
Thank you. Bye.
Thank you.